Hi friends, I am Raju Angadi Vishwanth here, a certified financial technician and a SEBi registered research analyst, a trader, trainer and a transformer with more than a decade of experience in trading and researching in financial markets. So, in today's topic, we are going to discuss about the Nifty PE ratio and a debate that a Nifty PE ratio is at the higher levels and it will crash. Nifty PE ratio is price P ratio, basically we call it as price to earning ratio, is at 37.84, and there is a debate and most of the channels and everybody is discussing that P is too high and the markets will crash. Will there be other scenarios how it can pan out in different case scenarios when the PE ratio is higher? Is that today we are going to discuss. And it is not necessary that we should crash or the market should crash if the PE ratio is higher. Due to the pandemic, the earnings have gone down, the GDP growth has been negative 23% in the March-June quarter, and we are in a V-shaped recovery. While let us get into the topic again. What is the P ratio? P ratio is basically a price to earnings ratio, a stock in which a current market price, how much the company is earning per quarter, per annum needs to be discussed. Well, the bunch of stocks constituted makes an indices which forms an index, and a collective earnings of the companies at the current price decides the price to earning ratio. It is a indicator which is used to judge the market is fairly priced or overly priced, which can give you a trends, but a combination of other indicators obviously needs to be used because it can be misguiding. If you just use only a P ratio, price to earnings ratio, it can be misguiding. Solely we should never use any one of the indicators to predict the direction. I'm not against or for the markets will crash. As the trend prevails and trend resumes, we need to be with the trend. As of now, the markets are trending upwards, so be in an upward trajectory, trade on the bullish bias rather than anticipating a correction. Usually most of the traders, swing traders as well as the investors, what they do, they whenever the markets are moving up, they wait for the price correction to happen, else they wait for the market trends to reverse. So as it is quoted, crowd is always right except the major market turns. So just solely based on the PE ratio never judge. Usually historically 27 to 28 PE ratio markets have corrected, but this is completely a different case scenario. This is an exceptional scenario where we are seeing 37.8 or above 35 as a PE ratio. Historically we are at all time highs, and also markets are trading at all time highs. So friends, just relax, ride the trend. We are going to go more in deep to understand. So where you can see the PE ratio you can watch out in NSE India products equities, where you can get the PE ratio, the dividend yield. The PE ratio is directly proportional to the earnings of the companies. The Nifty constitutes of a top 50 companies in the India, which of their earnings is constituted, which constitutes the Nifty's PE ratio. Well, there can be a scenarios how it can work. A market crash by 40% while the PE ratio is around 37 38, can come back to 26 to 28 zones. That can be one case scenario where most of them are expecting, but this can be a different case scenario at this time. While earnings can grow by 40%, market can stay flat and the PE ratio can come to 26 to 28. Well, a decent 15 to 10 to 20% of correction in the markets with the earnings growth of 20 to 30% and a time correction happening in the next couple of quarters, the base effect and the inflation showing the signs of improvement, even the IIP data getting improved. So there is a v-shaped recovery, particularly in Indian markets. If that happens to be true, as the markets have been overheated, we have seen a good impulse move with a v-shape all-time highs, while from last year highs to this year highs, markets are just up by 10%, but P ratio when it was at 12,400 zones was at 28. P ratio is up by 40%, whopping 40%. So fundamentally it is not justifiable, some say, but this is a one-off scenario where we have seen a pandemic and the effects we have been witnessing. So watch out. On a expectation of earnings, markets are rising and the base effect and the inflation is taking, usually markets discounts the future. Markets are usually 6 months ahead of the earnings. Based on an anticipation or a hope, markets moves up or comes down. So that's how it happens. While the crash happened in 2020, which usually happens in every 8-10 years time, but before that the actually cracks were seen. Even we are seeing the earnings contraction, the problems were seen with the ILFS and all the things, even the bonds and the housing finance companies cracked in 2018 January or 2017 November. Already the mid cap cracks were seen where the correction actually started. We started the correction far ahead in the mid caps. Only certain selective large caps held on to the Nifty while the mid caps cracked. That was a clear indicator. So what can happen now? Earnings catching up with the time correction and some certain correction around 14,000 zones with a 5-wave impulse. What we are seeing can correct, and the next leg of 5-wave impulse can start if the earnings catch up. That is different case scenario. Anyways, Elliott waves I was talking. We will talk about the Elliott waves and the probable counts in our next other videos. But as we are talking about the PE ratios, here earnings can grow and the PE ratio can dramatically come down. That's what I mean to say. Markets correction by some 15-20% or 10-15%, even PE price to earnings growth, if we can see, PE ratio can come down, and the also the forward earnings projection. Usually the analysts and the markets look on the forward earnings. If the PE comes to 25 to 28 zones and the forward earnings is from 18 to 22, then again markets become attractive and we can see the rally again back. So that's how one can analyze the PE ratio. Don't be get into a trap that just on a high PE ratio markets are going to crack or crash. While the dividend yield is one of the other indicators which one needs to watch out to get a gauge. Whenever the dividend yield has gone up above 2 to 2.25, markets almost near 2.25 markets have crashed historically. While whenever the dividend yield on the Nifty 50 comes down to 0.8 to 0.9 zones, markets have started correcting. If the dividend yield rises towards 2 to 2.5, then markets become attractive. Then the buying emerges. So as the chart indicates clearly, 2008 when markets came down to 2000, somewhere around 2002 to 250 odd zones, Nifty came. The dividend yield was around 2 to 2.25 of the Nifty. So the market looked attractive and the buying emerged. And again in 2020 when the dividend yield touched around 2, the extreme zones, the higher band, the markets cracked. Now currently the dividend yield is around 1.15. So we are not at hit the alarming band of 0.8 to 0.9 or 0.75 to 0.9, broadly what we can call. So with a less attractive dividend yield, stocks become unattractive. With a very good dividend yield at lower prices, stocks become attractive. So we are still have a room for a upside, which is what the charts are hinting. So that's about the dividend yield, which also we need to see along with the PE ratio. So dividend yield is still not on a danger zone, which hence there is a room for a upside at. While the PE ratio on the Nifty chart compared, here you can see PE ratio around 37 zones, which usually moves up and comes down in a correlated way. So along with the PE ratio, one needs to watch out the levels accordingly to establish the trade setups. So coming back, P ratio again just a mere sole indicator. We need to see the dividend yield, which gives a clear hint. Along with that, P ratio, if the earnings growth happens, P ratio can correct. That's what it means. Now we will have an intermarket analysis along with the P ratio what we have discussed. Currently we are in a starting stages of a expansion cycle after a contraction, commodities going up, stocks going up, and the bonds going up. All together we are seeing a rally in commodities, a strong commodity rally. Copper is trading around all time highs around MCX copper, I mean to say around 600 620 zones. Even the base metals have risen. Zinc is trading about 200, where the consumption and the prices have been increased. We are getting into an inflationary environment after 13 years of deflation from 2008 what we have seen. So inflationary environment is coming back. In the next stage we can see bonds coming down. We are currently in a stage 3. Still we can see the commodities and stocks rally in the early stages of the expansion. So we are in that cycle. So currently commodity, stocks and bonds all rallying. So enjoy the ride. In the next stage we can see still commodities and stocks inching higher. So we are in a strong trend. Don't get confused. That is a brief analysis which you can watch out for your investment policy. Well, I'm not advising anyone to buy immediately on the stocks front, or I'm not against the crash, but understand the market analysis cycles along with the dividend yield chart. Don't solely depend on the P ratio is the agenda of this video, to make everyone aware on how to establish the trade setups and the investments. Allocate your capital. Still there is a room for a rally, and add on the dips. So if you are having a 1 lakh rupees of capital, I would suggest on a quality stocks or a growth stock. Select the sectors. Reality is in a secular trend. Pharma is still in a secular trend on a corrections. Add 25% of your capital. Allocate 25% of your capital on the selective sectors. Even infra can grow. So then whenever a correction happens, intermediary corrections will always be there in the markets. Next couple of years to 3 years we can see a rally. We'll discuss about the Elliott wave analysis and the chartical structure of where the Nifty is headed with the probable trends in our next video. So that's it on the PE ratio. Nifty may or may not crash just solely based on the PE ratio was the clear idea or the agenda behind this video. If you like the video, please subscribe to our YouTube channel for the further updates. Join our Elite Traders at community on Facebook as well as Twitter. Thank you everyone. We believe sharing is caring. Share our videos. We'll come up with more of the knowledge sharing and the investment ideas as well as the strategies. See you in our next video.